Welcome. Today we're diving deep into a really important provision in the new Income Tax Act 2025, Section 56. This section tackles a major headache for banks and financial institutions, so let's get right into it. So picture this. A bank has a loan that's gone bad. It's now what we call a non-performing asset, or an NPA. Now, on paper, interest is technically still being earned, but in the real world, not a single rupee is actually coming in. So the big question is, should that bank have to pay tax on this, this ghost income? This is exactly the problem that Section 56 is here to solve. So here's our game plan for today. First, we'll introduce the section and its purpose. Then we're going to break down the provision into its key components. After that, we'll walk through a really practical example, touch upon some common compliance issues, and then wrap up with the key takeaways you need to remember. All right, let's start with the fundamentals. Section 56, which you might remember as being similar to the old Section 43D of the 1961 Act, it gives a special method for taxing interest on these bad or doubtful debts. It's a very targeted provision, meant only for certain financial institutions. And really, its main goal is to bring the tax rules in line with the practical, prudential norms that are set out by regulators like the Reserve Bank of India. You see, the key idea here is that it's a departure from the strict accrual system of accounting. Normally, you recognize income when you earn it, not necessarily when you receive it. But for an NPA, that earning is pretty much just theoretical, right? So Section 56 acknowledges this reality. It allows the tax on this interest to be deferred. The tax only gets triggered when the interest is either credited to the profit and loss account or when it's actually received, whichever of those two things happens first. Okay, so now that we know the why, let's really get into the nitty-gritty. We're going to deconstruct this provision to understand the who, the what, and the when of how it all works. First up, who does this apply to? Well, the law is very, very specific about this. It's not for everyone. As you can see, it covers a select group. We're talking about scheduled banks, public financial institutions, state financial corporations, state industrial investment corporations, and also, as clarified by the rules, non-banking financial companies, or NBFCs. Now, this gets to the absolute heart of Section 56. The interest on a bad debt becomes taxable based on one of two triggers. Trigger 1, it gets credited to the profit and loss account. Or Trigger 2, it's actually received in cash. The tax kicks in based on whichever of these two events happens earlier. It's that simple, but it's absolutely crucial. So what exactly do we mean by a bad or doubtful debt? Well, for the purposes of this section, it's not some subjective call. The definition is tied directly to the regulatory framework. A debt is considered bad or doubtful only if the institution has officially classified it as a non-performing asset. And that classification has to be based on the strict guidelines issued by the RBI. Okay, theory is great, but let's see how this thing actually works in the real world. I think a practical example will make that whichever is earlier rule crystal clear. Let's imagine a fictional bank. We'll call it ABC Bank. They've got a loan out that has, unfortunately, turned doubtful. We're going to look at how the interest on this loan is treated over 2 consecutive tax years, 2026-27 and 2027-28, to see exactly how Section 56 plays out. All right, let's walk through this table together. In the first year, 2026-27, there's 1 lakh rupees in interest that's due. Now look closely. Did they credit it to the P&L account? Yes. Did they actually receive the cash? No. But because the P&L credit happened, our whichever is earlier rule is triggered. That means the full 1 lakh is taxable. Now let's jump to the next year, 2027-28. Same amount of interest is due. But this time, look, they did not credit it to the P&L, and they also did not receive the cash. Since neither of the triggers occurred, the taxable interest for this year is 0.
And there you have it. This shows the provision in action perfectly. The bank's accounting decision in a given year directly impacted its tax liability. In year 1, by crediting to the P&L, they triggered the tax. In year 2, by not crediting it and not receiving it, they deferred the tax. It's a fantastic demonstration of the law's intent.
So understanding the rule is half the battle. Applying it correctly is the other half. So let's talk about some key compliance points and some common pitfalls that you, as professionals, really need to be aware of. To stay compliant, here's a simple 4-step process. Step 1. Make sure you've correctly identified all your NPAs based on the official regulatory norms. Step 2. For each of those assets, you have to track both P&L crediting and actual receipt. Step 3. Diligently apply that whichever is earlier rule to figure out the taxable interest. And finally, step 4, and this is so important, maintain meticulous documentation. Clear records are absolutely essential to justify your tax position if you're ever questioned. This brings us to a really critical, practical question. What if a bank, like our ABC Bank, pays tax on interest in 1 year, but then, down the line, they never actually receive that money, and the loan has to be completely written off? Is that tax payment just lost forever? Well, fortunately, the law has an answer for this. As this quote from Section 56, subsection 4 clearly states, if you've already paid tax on interest that you later write off as being irrecoverable, you're allowed to claim that same amount as a deduction. And you claim it in the year you actually do the write-off. This provides a really crucial safety net and makes sure that, in the end, you're not paying tax on income that was never really yours to begin with. We've covered a lot of ground, so let's do a quick recap. These are the most important things you need to remember about Section 56. All right, here are our 4 key takeaways. First, Section 56 is all about aligning tax rules with the RBI's practical norms for NPAs. Second, remember the golden rule. Tax is triggered by either crediting the interest to the P&L or actually receiving it, whichever happens first. Third, this rule only applies to a very specific list of financial institutions. And fourth, that crucial safety net exists. You can get a deduction for previously taxed interest if the debt is later written off for good. And that's our deep dive into Section 56. We really hope this has helped clarify the details of this very important provision. If you found it useful, please do us a favor and like, subscribe, and share. Thanks so much for watching. Just a quick reminder, this explainer is for educational purposes only, and it doesn't count as professional advice. Tax laws can and do change, so please always consult with your professional advisor before making any decisions.